S&P 500 made a brand new high today of $733.46, and we are so back making videos again. We are making videos the past few days. The reason is because the charts were more or less a bit declining, and I'm a very big chart reading, and especially indicators and charts together. So it's very, very important. If you stick to your strategy and you're very disciplined and you don't trade for a few days, then because it's not just the right time to trade for you, then you can really cash in. With that said, please don't forget to like, share, and subscribe. And now let's break down the daily charts. Okay, so let's break down the charts in SPX, which is the S&P 500 index and not the ETF, because it's just easier to break it down, the evaluation here. It's the same kind of patterns, everything. Don't worry about it. So now we opened up at 7294. The highest of the day was so far as 7357. I'm recording about 2:45 p.m. Eastern time. I already made my money, cashed out. Now it's time for YouTube, right? So let's do this. So as long as we're above the trend, I made a trend line from the bottom going all the way up sideways, all the way across. So as long as we're above the trend line, you're able to be into long calls. Just hold on to the calls until we got the signal to sell. Now, before I tell you why I went to sell over here, for when you see this chart again, people probably might have gotten faked out. I mean, probably 100%. You have here a double tap. People thought it was going to crack down, and then maybe possibly even a triple tap, and you thought it was going to crack down. That's what's very important. Trend lines are extremely important. As long as we're above the trend lines, you can still hold into long calls, and that's what happened as well yesterday and 2 days ago as well. You're looking at all the charts further. It's just the same thing, and it was like whatever. But finally today, we finally got more results. That's why I'm creating this video here. So we have, as long as we're above the trend line, you're able to stay into calls. So now let's get rid of this trend line over here. Let's go further with the chart. So now over here, we have, if you zoom in, you see we have a double tap. We have one loop over here, and then the second loop over here. So now how do you know when to enter, when to exit? This is not such a big double tap. I mean, it could have been a big double tap if it would have formed and came all the way down. Let's make a line across, let you guys understand right over here. Around, if it would have cracked to this level over here, then you guys could have cashed in a lot of money. Instead, the market decided to go otherwise and shift across. But if you're still in puts over here, you were able to make money. Now, how do you know when to enter? You make a trend line from over here, like the nose over here. You see like a bit of a V shape over here. So you go from the bottom, going all the way sideways up, aligning it on top. Beautiful, right over here. So actually, you can make it also with this candle right over here. This candle sticking out. This one right over here. Let's make a circle across. I you guys see it. You see this candle over here? This one is making it or breaking it. As long as this one, as soon as you see this confirmation, okay, so now you know, as soon as you see the first red candle going below the trend line over here, you know to enter into puts. And that's where you entered. And this candle right over here, let's move this up right over here. You guys should see, broke it for us. And this is where we knew into purchase into puts. So you change the puts and you keep it along. And although we have over here, so a lot of experienced traders, smart traders would sell it as soon as they see the first big green candle, so they would sell it right over here. Like right over here. But a lot of people had patience and kept holding it, or because they're not so experienced, but they were still able to make money. I'll tell you why. If you see over here, look at these two candles over here. This gives you the confirmation that we're going to be, sorry, let's just center it. This gives you the confirmation. When you see this, you see really bullish candle and a really bearish candle aligned almost together equal, then you know we're going to have another leg down. And if you know we're going to have another leg down, that's exactly what happened. And then we have another trend line that where it was below the trend line, you're able to still hold into your puts. As soon as you saw the first green candle right over here, this one crossing above the trend line, then you have to sell automatically. And if you guys didn't sell right away, you could have lost money, because especially if you're doing zero-based expiration, if you're a high risk, high reward guy and you wouldn't sell right away, then you could have sold your contracts on a loss, because it's very, very small movements. That implied volatility is not so high at all. The implied IV is 17.29, not at all high. So you guys really have to watch out. Now, same thing vice versa over here. Let's get rid of this. Then before you know it, we had a nice V shape. So if you see a V shape, you get out right away from your puts, especially. We have, let's make the trend line again right over here. This is one, and then the second one is going up across over here, right? This is a V shape. Now, V shape is where most unexperienced traders lose money. The experienced traders know to sell automatically as soon as they see a V shape forming. The V-shapes are not so common in the S&P, but they are pretty common. What I'm trying to tell you is they come unexpected. You cannot, there's no previous charts to tell you, hey, we're going to have a V-shape, we're not going to have a V-shape. So if you see this V-shape, you have to get out from your puts, and you can enter into calls and still cash in. But as soon as we get, how do you know when to exit into your calls over here? So if you would have still kept on calls over here, you still would have made money actually in this kind of market. But in a normal kind of market, and I'll tell you why in a second, but first, in a normal kind of market is as long as when you get it's usually over here. It would have formed until over here. So now we did reach over here, but later on. That's for all the unexperienced traders that still kept their calls. Experienced traders would sell their calls, wait for the next signal, and then purchase again calls. But But usually how it is if it doesn't break above this candle over here, this line over here, then that means you have to sell it. If it cracks above, then you can still hold your calls. That means the V-shape is continuing and it's going to go all the way up. And you can see this in the daily charts, actually. Look at the daily charts. We had over here a V-shape, you see? V-shape, where everybody thought, okay, the market's going to come back down and it's going to cause a double top. Instead, no, we got still bullishness. We still got bullish. Why? The market's creating newer highs. The earnings reports are coming out solidly. And same thing over here. We make a over here. See, this is where the V-shape would have finished. Or over here, this candle over here would have kept it. Or maybe you could have made it even lower, like this one over here. But it's not the point. Yeah, this one right over here. Let's make a thing over here that you guys can see. You see? This one over here, this kept our V-shape. This is where I started. V-shape up, down, and then V-shape up. And then we cracked above the line, and that's where we know we're going to climb even more. So you have to remember that. With that said, let's go back to the 1 minute chart and let's continue with the chart patterns. So now over here, not only is this a V-shape actually, but this is also a head and shoulder. Now, inverse head and shoulder. Let me explain. This is our head right over here. You see? Okay. And this is our left shoulder. And this is our right shoulder right over here. And if you know that this is a head and shoulder, the inverse head and shoulder, then you know we're going to crack even newer high, and we're going to crack all the way above. And that's exactly what happened. So you have this line over here, of course, that we made for the V-shape, right? So if you would know about this V-shape before, right, you would have this line automatically. So now as soon as we crack above this line, then you know what to enter into calls again, and you keep in long calls all the way up until we reach the highest point. And how do you know when to exit? Let's say we make it from here, this candle over here, going all the way across. Can make it like this, perfect, right over here, just like this, right over here. You just make a line across, like more or less wherever you put in the line, it should be more or less the same thing, evaluation. As soon as you see the confirmation that we're going below the trend line, you have to sell, and that's where you cash in, and then you're done trading, right? You make your money. Now, this is where the market is continuing, so I don't know where this market is going to be trending in the next few minutes, so we'll keep that we'll explain that in the next video. If there's a nice chart pattern. So with that said, this is what the chart patterns that we had today. And looking at the VIX, it's slowing down. Meaning to say the VIX is sitting now at 17.14. If it's below 16, that means the market is 100% bullish. If it's above 16, the market is a bit in fear territory. And the reason why it's still above 16 is because we're not done with the war yet, although there's still a ceasefire and the America didn't strike in again. Although Iran tried to shoot down 2 U.S. boats, whatever it is, but again, as Trump says, hey, we're almost very close to a peace deal, so you never ever know. We just have to pay very much attention to the news, especially to political news. You never know what can happen. You never know. So with that said, just pay attention to the charts, pay attention to everything. Not only that, let's go to the RSI. The RSI right now currently is at 50, but let's go to the daily. So the RSI is all the way bottom left right over here, right? See what it is. Let's move it on. So the RSI for the daily is at 79. Which means as long as it's above 70, it's an overbought signal. So it's another indicator that you really have to watch out. But a lot of times, and especially now that happened in the past 2 weeks, is when it's above 70, it could stay above 70 for like 3 weeks. Now this week actually is the 3rd week. So can be the market will be heading towards a roller coaster down either Friday or next week, possibly even tomorrow. You never know if it's political news. But based off trend and technical analysis, if you're looking at the RSI, if the RSI goes below 70 again on the daily chart, then we can see a nice pullback from its all-time highs. But again, we all have to just pay attention. Keep your eyes open. Please don't forget to like, share, and subscribe. Thank you for watching.